This morning, December 26th, 2025, I witnessed something that should not exist in a functioning global market, something that quietly exposed a truth most people have been trained not to see, because today, the price of silver split into two realities, and that split told me everything I needed to know about the system that has controlled this metal for decades, because while New York, through COMEX, showed silver trading at $75.92 per ounce, Shanghai, the largest physical consumer of silver on Earth, closed physical silver at nearly $82 per ounce, a gap of $6 to $8 that cannot be explained away as a premium, a currency quirk, or logistics issue. Because, historically, the difference between Shanghai and New York is measured in cents, not dollars, and when a global commodity trades at two radically different prices at the same time, it is not a market inefficiency, it is a confession, a silent admission that the price you see on your screen is no longer anchored to physical reality. And for the past 50 years, the world has accepted that silver is priced in New York and London through COMEX and the LBMA, benchmarks referenced by refiners, dealers, governments, and industrial buyers alike. Yet today, the largest buyer of silver on the planet is openly paying far more than that benchmark, not out of speculation, but necessity. Because China is consuming over half of global industrial silver for solar panels, electric vehicles, electronics, 5G infrastructure, and military technology. And they cannot source the metal at the paper price, so they are paying whatever it takes in Shanghai. And this is not temporary, because traders are literally air freighting silver from London to China, something almost unheard of due to weight and cost. Yet the arbitrage still refuses to close, which tells us one of the prices is artificial, and that price is COMEX, because COMEX does not trade silver. It trades promises, paper contracts representing 5,000 ounces each, where historically less than 2% ever result in physical delivery, meaning bullion banks can sell hundreds of millions of ounces they do not possess using leverage, flooding the market with artificial supply that pushes prices down. And while this mechanism is technically legal, the abuse of it was proven in court when JP Morgan pleaded guilty in 2020 to a criminal conspiracy involving precious metal spoofing, paying $920 million in fines, while two senior traders were sentenced to prison for manipulating silver prices for nearly a decade, confirming that the prices seen during those years were not discovered by supply and demand but engineered, and yet the structure that enabled that manipulation still exists today, which is why we continue to see the same signature behavior, the morning slams during New York hours, massive paper selling whenever silver approaches key resistance levels, suppressing breakouts through sheer volume of fake supply, a fact even acknowledged by former CFTC officials who admitted the agency knew silver was being tamped down but feared the consequences of letting it run. And now that suppression is colliding with physical reality, because Shanghai is in backwardation, where spot silver trades higher than futures, a condition that only occurs when buyers no longer trust future delivery. And on December 24th, Shanghai silver showed backwardation of over 60 cents, an enormous red flag in a market where even 10 cents is rare, signaling acute physical shortage, which makes sense when you look at China's inventory levels, because registered silver stocks on the Shanghai Futures Exchange have fallen to roughly 17 million ounces, the lowest in years, while withdrawals continue daily. And with China installing hundreds of gigawatts of solar capacity, requiring thousands of tons of silver annually, inventories are being drained faster than they can be replenished, especially when global silver supply is structurally constrained, since roughly 80% of silver is mined as a byproduct of other metals, meaning higher silver prices do not quickly result in higher production. And the world has now experienced 5 consecutive years of silver supply deficits totaling over 600 million ounces, silver that is gone forever, pulled from inventories held by COMEX, LBMA vaults, ETFs, and private stockpiles, leaving COMEX registered inventories down over 70% from their 2020 peak, while London itself experienced stress in late 2025 when massive Indian buying forced the LBMA to source metal from multiple regions, including China, prompting China to export a record 660 tons of silver to London in October, temporarily relieving pressure there but further draining Chinese stockpiles, which is why the Shanghai premium has now exploded even higher. And the most telling evidence of what is coming is the behavior of JP Morgan itself, the same institution convicted of suppressing silver, which has since flipped from one of the largest paper shorts to the largest holder of physical silver on Earth, reportedly accumulating over 750 million ounces, nearly a full year of global mine supply. A move that only makes sense if the bank understands, though, the paper market is nearing failure and physical metal will be the only asset that matters, because today we see exploding exchange for physical premiums, soaring silver lease rates that briefly hit nearly 40%, levels only seen before historic silver price explosions, and a futures market built on the assumption that delivery will never be demanded, now facing the risk of forced cash settlement if too many participants ask for metal that does not exist, which would permanently sever paper prices from physical reality. And as this unfolds, the likely path forward becomes clear. Starting with a gamma squeeze, as options market makers are forced to buy futures near key strike prices, driving silver rapidly higher, followed by media attention once prices break psychological levels, igniting retail panic buying into an already supply-starved market, pushing physical premiums to extremes, and finally, industrial capitulation. As manufacturers realize price no longer matters more than securing supply, because production without silver is impossible. And beyond that lies government intervention through margin hikes, position limits, taxes, or emergency rule changes, not to protect markets, but to protect the system itself, because silver is now officially recognized as a critical mineral, and governments do not tolerate uncontrolled price discovery in assets essential to energy and defense. Yet none of these actions change the underlying reality that the paper price is failing, the physical price is asserting itself, and the spread between Shanghai and New York is the clearest signal yet that the emperor has no clothes, because today silver is not $75. It is $82, where real buyers operate, and soon the paper market will be forced to converge upward or break entirely. And when history looks back on this moment, it will not remember headlines or official prices. It will remember that December 26th, 2025, was the day the lie became visible to anyone willing to look. And from that moment forward, the greatest wealth transfer of the modern era was already underway, separating those who held real metal from those who trusted paper promises.